Hello folks, welcome to the Wikipedia world and I am Abhinay Gupta. Today again we'll continue with the topic, the Banking Regulation Act 1949. So far we have discussed what the act is all about, we have discussed the definition of various topics, various terminologies. We have seen section 7, section 9, 10A, 12A, section 17, section 18, the reserve fund, cash reserve, etc. Today we'll again move ahead to the next section that we have, which is section 21, the powers of RBI to control advance by the banking company. So we have already discussed that RBI is a supreme body governing all the banking companies, right? It has the power to interrupt into the day-to-day activities of the bank, election of the board, directors in the board, the shareholding pattern of the shareholders, mergers, acquisition, everywhere. RBI has their interference, right? So RBI also has the power to control the advance that the banking company would be making, right? So, and this topic has been recently asked in your CA final November 2008 examination, right? So if RBI is controlling the advance of a banking company, right, they are doing it for some specific purpose, right? Whenever any policy is formulated by RBI, right, it has to be in the interest of the public, general public. It should not be harsh on the public, right? The provisions of making advances, the precautions that have to be taken, the limits for advances and etc., they have to be beneficial for the public, right? They have to be in the interest of the general public. It also has to be in the interest of the depositors. Depositors are the people who are depositing their money into the banking company. We have already discussed in the definition of the banking that banking is accepting, for the purpose of lending and investment, the sum of money from public. So it is the business of accepting money from public. So the public who are giving money to the bank so that they can accept are the depositors. So if they are the basic source of working of a banking company, so their interests have to be kept in mind before formulating any policy, right? And the third thing is the banking policy. If RBI is formulating a policy for advance, it is a subset of the basic fundamental policy that the banking company already has, right? So the banking company is like the head, and the branches and the small divisions of it are the other policies, like the policy of advance and other things, right? So three things that you have to keep in mind is the public interest, interest of depositor, and the banking policy at large, right? The question that was asked in 2008 was, how does RBI regulate it? Right? Well, like what are the steps taken and how does it have the control over the advances? So we'll continue with the topic ahead. It is section 21 subsection 2. Right? Now this is the procedure of how RBI goes ahead with achieving the desired objective. So RBI provides the following direction, and these following directions can be for any banking company in particular or can also be for all the banking companies in general, right? So it depends. If it is a general thing that the RBI wants to bring out in the market, it will just rule out a new policy for all the banking companies and they'll have to follow it. But if there is any specific country that is working a little different from the rest and RBI has a concern in that, and just to make it for the interest of the public, for the interest of the depositor, and to run it parallel to the banking policy, it may amend it, okay? So what are the directions? Now we come down to the directions. So RBI may direct the purposes for which the advances can be made, and right, and can also specify some specific purposes for which the advances cannot be made, right? So the purpose of making the advance will be directed by the RBI. Like, okay, these are specific causes for which you cannot make any advances, so please avoid. Other than these are the basic things for which you can always make an advance, right? So that is how RBI gives down the direction. First is the purpose of making the loans in advance will be governed by the RBI. Next is the margin of secured advance. So we have already seen that loans in advance are secured as well as unsecured. If it is unsecured, that is, there is no security that you have to provide. But if it is secured, we have seen that the market value of the security that you are giving to the bank should be more than the loan amount that you are taking. Right? Loan is for you, it is not for the bank. You are taking loan, and your loan is an advance from the bank's point of view. If you can step into the shoes of the bank, it is an advance that it is given to you, like the loan. So RBI would direct the amount of margin, the gap that has to be between the market price of the security you're giving and the loan that you're taking, or the advance that the banking company is making. So like it would recommend the banking company to keep at least 5% margin, 10% margin, 15% margin as per the requirement, and that can be for a uniform margin for all the banks in the industry, or can be given out to any specific bank specifically, right? So that margin of advance will also be directed by the Reserve Bank of India. Then the condition of the maximum advances. So RBI would direct the maximum amount of advance, the limit, the ceiling of the amount of advance that the banking company can offer to any other company, any firm, an individual, or any association of person. Right? Now, how does Reserve Bank of India determine the limit? What is the basis behind it? Basis on what will it determine the limit? So it will determine the limit on the basis of the paid up share capital, the reserves, and the deposits of the banking company. Right? So it will always depend. If they have more reserves than the capital, more reserve and security premium and stuff, or do they have less reserves, they have high amount of deposits taken, or they are going low on deposits. These are the parameters that the RBI would consider before setting out the maximum limit for the advances. Right? It would also direct the maximum amount of guarantee that the banking company can give to any company, any firm, an individual, or any other association of persons. So the banking company takes guarantee on behalf of any other company. Okay, you want to work ahead with them or want to give them something, any property, money or something, I will take the guarantee on behalf of that person that I will repay you the money if they don't. That is the work of a guarantor. I'll make sure that you get your money or your asset back. So RBI will decide what is the maximum limit up to which the banking company is allowed to take the guarantee, to give away the guarantee. As per the conditions that we have seen already above, like giving due regard to the paid up share capital, the reserve, the deposits taken. If the RBI feels that no, the company is not in a very good position, so obviously it would restrict the amount of advance or guarantee that is to be given. Right? But if the banking company is flourishing very well and it is having an aggressive approach into the market to explore and go beyond, then the limit can be relaxed to some extent. Right? So the maximum amount of guarantee as well as advance, both are directed by the Reserve Bank of India. Then finally what you have is the rate of interest and the terms and conditions based on which the advances will be made will also be governed by Reserve Bank of India. Right? What is, if you are giving an advance to somebody, obviously what you get back is the interest. Right? So banking company will also always want a higher rate of interest, but the borrower will also always want a lower rate of interest. And we have already seen that the RBI, when it works in the interest of the public, the depositor and the banking policy. So it is not in the interest of the banking company. Right? So if the banking company desires to take away 20%, RBI would say no, it is a harsh step towards the public in general. So we'll have to consider the interest of the public and bring it down to 7, 8, 6% or whatever it is. Right? So the rate of interest as well as the terms and conditions based on which the advances are given and the repayment schedule and everything will also be governed by the provisions laid out by the Reserve Bank of India. Right? And the final and the very important point that can be a jumble for you in the examination if you get a case study question on this is that the rate of interest would not be subject to scrutiny by court. It is the discretion of RBI. Right? It has the power to lay down the rate of interest, and once RBI lays down any rate of interest, the court is nobody to challenge that. Right? In case of banking, we have already seen that RBI is the supreme body. So next we have section 29, that is the account and balance sheet of a banking company. Right? So what are the provisions behind the accounts and balance sheet of a banking company? Like any other company, the account and balance sheet of a banking company too is prepared as on the last working day of the financial year, of the accounting year. Right? Accounting year and financial year. It's not the calendar year, it is the accounting year. Right? And it will be prepared in the form set out in Schedule 3. Right? So as per the third schedule, the balance sheet and P&L will be prepared, and that will be prepared as on the last working day of the financial year. And then the accounts will be signed by the manager or the principal officer of the company. Like we say the chairman, or actually the head of the company. It may be the manager, principal officer, or by whatever name you call the head of the company in various companies. Like you have different hierarchy, different names to call them. So whoever is at the top, the manager or the principal officer, he will sign the accounts and balance sheet of the company. Along with him, 3 other directors will also sign the accounts and balance sheet. But in case of any company, if there are no 3 directors, there are, for example, 2 directors. That is the minimum requirement in a private company. So if you have 2 directors, then all of them. If you have 3 or more, then minimum 3 directors. Right? So that is the logic behind it. And Companies Act 2013 is also applicable. And if we talk about the applicability of Schedule 6, then that will also be applicable for preparation of balance sheet and P&L. But as far as it is not inconsistent with this act, with the Banking Regulation Act 1949. Right? If it is not inconsistent, we'll obviously apply the Companies Act, right? The Schedule 6. But if there is anything specific given in the Act, we'll go by the provisions of the Act, even though it is not in consistence with the Schedule 6, right? And you have been asked a question on this recently in your May 2013 examination, where you were simply asked to state the provisions relating to the accounts and balance sheet of a banking company, right? So that is all for the day. We'll conclude the class over here. We'll take up the remaining topics in the next lecture. Until then, it is Abhinay Gupta signing off. Stay tuned for the next lecture. Hope to see you there. Thank you.